when I was asked to speak here, I was actually wondering what my angle, what my perspective could be. And I wanted to take a little bit a step back and look at what's going on in the world a little bit and tell you what I think from my personal experience in the banking world globally, to show you some things that are happening elsewhere, somewhat in Asia, but also in Europe, what's going on in the banking sector. I thought that would be more useful than reformulating recommendations to what should happen or what we think should happen in the Ukrainian banking sector. Everywhere we go, fellow bankers, we get questions about what we think should happen, why foreign banks are not doing what people think we should be doing, and what our recommendations would be. What I think is the absolute benefit of a conference like this is that we actually have the opportunity to talk about an international mindset and an international way of thinking, instead of talking about how many foreign banks we still have and how many will be leaving. That's the perspective that I want to take over the next 10 minutes. 2 words about my professional experience, and I will connect that a little bit to of course, what we do here. I worked over the last 20 years in some really exceptional countries. In Indonesia, in China, and in Korea. And I want to, for each country, I want to give you one bullet point to make you think what is possible in the market and what the challenges are from a banking perspective in my personal experience. First of all, Indonesia, of course, what you probably need to know is that until 1998, this was what people call a dictatorship, with a very, very centralized corruption system centered in the president. And since '98, after the revolution, after Suharto left, the country developed in a, I should say, in a very positive way, in a very democratic way, and has been growing at an average rate of between 6 to 8% every year since 1998. It is now the 13th largest economy in the world, and it was far behind in '98. The challenge for a banker in Indonesia, in my experience, is to choose between the good people and the bad people. I think this may be a problem in every country, but in Indonesia we have, of course, let's just say we need to choose. Yeah? We need to. You can have very good customers and you can have bad customers, and if you choose the wrong ones, then your business model will suffer terribly. If you pick the good ones, you can be extremely successful. In China, what I would say, of course, everybody knows that China is now the 2nd largest economy in the world. It was not like that after the Cultural Revolution. And it is forecast that China in 2017 already will be the largest economy in the world. What I think is the challenge in China for a banker is the entrepreneurial spirit. If your neighbor has a house and you don't have a house, you actually want to build a bigger house. I think here it's a little bit the opposite. People seem to try to destroy the house of the neighbor more than building a bigger one. As a result, this is extremely competitive, and this also comes from a communist model, but it is now one of the biggest problems in my experience to handle the entrepreneurial excessive entrepreneurial spirit of the Chinese. One of our assistants in the Beijing office lives in a very big house. Actually, of course, most of our colleagues in China are, of course, not in the lower classes, so they are relatively wealthy. And one of them lives in a very big house with an escalator, not with a lift, but with an escalator, just to show you a little bit what the spirit of entrepreneurship can mean there. Now, my 3rd country, Korea, what I can say there is, of course, that this country has developed into the 11th largest economy in the world over an incredibly short period of time. In 1953, after the war between North Korea and South Korea was just finished, North Korea had a larger GDP than South Korea. So it was wealthier than South Korea. Now the GDP of South Korea is $1.6 trillion. It's the 11th largest in the world, and this country only has 46 million people. There is, of course, a reason why I pick Korea to compare. This is an incredible achievement, and the more important point is that unlike Ukraine, South Korea does not have natural resources. There is basically nothing. 70% of the land cannot be used because it's mountainous and rocky. And they always, the South Koreans always say, we only have ourselves. It's the only natural resource in the country. And obviously they've done incredibly well. They continue to grow at 5 to 6% per annum and are now one of the biggest economies in the world. The challenge in Korea, and I also mentioned this for a reason, is to meet deadlines. Because everything goes incredibly fast, and as bankers we are used to handle requests for proposals, as we call RFPs. In most countries you then have 3 or 4 weeks, sometimes 6 weeks to reply, to make your proposal. In Korea this is a matter of 48 hours. So in that sense, Korea speed has become a competitive advantage. And mostly in Western Europe, absence of speed has become a competitive disadvantage. This is a little bit my introduction, Chairman, and I also have a PowerPoint, but I already mentioned most of what I wanted to say in my introduction, but you will see some facts to support this later on. So here I have a table with the most recent IMF data on GDP. You can see, of course, I did not want to compare everything, but what I do want to emphasize is that there are pockets in the world, geographical pockets, areas, in industries, and of course very specifically countries, which do very, very well. Later on I will show you that, of course, there is a correlation between GDP and financial wealth of countries, and I have some statistics to support that as well. So it's not as if the whole world is in a financial disaster. There are pockets of incredible liquidity and of very high amounts of cash in some places in the world. It's just a matter of how you look at it and how you handle it. As you can see here, we have for Ukraine 0.2% for 2012. And I think it is something similar for 2013 expectations, but of course it changes a lot. I think we cannot expect a lot of movement in that department for the time being. I wanted to pick some high-level points to compare what the situation was before 2008 and after 2008. This is not very new for you. I think you all know it. I just put it on the slides to focus a little bit and to remind you that actually the financial systems were probably overdeveloped before 2008, highly developed, very liquid, very high leverage. In respect of this leverage, this is actually a very big thing. In 2008, the largest bank in the world, who knows who the largest bank was at that time? Steve, do you know? No, it was actually Royal Bank of Scotland in respect of total assets. So RBS in 2008 was the largest bank with $3.5 trillion of assets. Now today, it's only number 8 after deleveraging with only 2.4 trillion assets. I'm not saying I'm not making a judgment about this bank. I'm just illustrating the changes in leverage in the financial system which have taken place and which continue to take place and which are at the origin of very, very significant job cuts across the banking sector in the world. And I think this is one of the tragic conclusions after 2008. I will have some numbers on that as well. High leverage, wide and complex product range, and comparatively high returns on equity. After 2008, of course, as I mentioned, significant reduction of leverage and complexity, Also regulatory expansion, Basel III, putting in place capital requirements significantly higher, 4.5% common capital, tier 1 additional buffers, but more importantly, and well, not more importantly, equally important, also very strict liquidity requirements and matched funding requirements, and even a leverage ratio introduced into the banking system on the back of a concept of risk-weighted assets, which existed before but was not required. So this actually, the combination of this means that banks, in reality, even though we think that banks are globalizing, in fact, banks are becoming more local most of the time because of the concept one bank balance sheet in one country. So liabilities raised in one country are more and more required to be used as assets within the same country to avoid shifting and moving of liabilities of deposit base from one country to another. So this is one of the very big implications of the regulatory expansion after 2008. Now, what people also don't always realize is that the large companies in the world have incredibly expanded their cash positions. I have some other data. This slide, because you all sit a little bit far away and you're all coming at middle age, so your eyes are not so the same. I've only introduced the point of percentage year-on-year change. These are not numbers, these are just the change since 2006 over 2008, very significant increase of cash levels at corporate level. Now, the reason for this is twofold. First of all, companies have started working much more strictly on their working capital. They were forced to do so because of the banking system credit crunch. So they were forced to improve their working capital positions. But at the same time, actually, companies find it much more difficult to find opportunities to use their cash. Interestingly, a few days ago, the Association of Finance Professionals, of which I am not a member, I just Googled it, mentioned that in 2013, the first quarter was the first time that the speed of cash accumulation was decelerating, was slowing down, which actually indicates an improving business confidence climate. So higher cash levels are not necessarily a sign of high business confidence. Interestingly, which companies have the highest cash levels these days? It's Apple, Microsoft, Google, Pfizer, and Cisco. So only Pfizer is in the pharmaceuticals, all the rest is IT and internet related. They have 24% of the US total in cash. And also very interesting, I hope I still have a little bit of time, still, yeah, sure. There's that most of this cash, almost 60% is actually outside the US, mostly for tax reasons. I'm not going to make comparisons, but of course, offshoring of cash is also a very substantial challenge in Ukraine. US companies have a total of $1.5 trillion in cash, and Japanese $2.8 trillion in cash, which are very, very large numbers. And of course, it's difficult to find opportunities for investment because for all practical purposes, the world has excess capacity in almost everything, from car production to telephone manufacturing. Everything we can actually make probably 5 times more than we currently do and not need to build new factories. Of course, we need innovation, but we don't need additional capacity, generally speaking. I'm almost finished because I'm not going to talk too much about return on equity, just to say that one of the reasons why banks are reducing their employee numbers so very significantly. Actually, at the end of last year, Reuters announced that around 20 major banks were globally cutting 160,000 jobs. HSBC was reducing 30,000 people, Bank of America 30,000 people. So the more you Google this, the more depressed you get. But of course, the changes after 2008, lower leverage, less complexity, more difficulty to make money in financial products because there are fewer financial products being sold, and combined with the need to have higher equity, to raise more equity, and of course to be able to demonstrate return on equity means that the banks have almost no choice but to reduce their cost base. This is what's going on in the world, and I think this puts a little bit a different picture to the eternal question we have about the foreign banking presence in Ukraine. It is not just about Ukraine, it is not a political question for Ukraine. Of course, the whole point is that banks are reviewing their strategies and they have a lot of other opportunities in the world. Yeah. Now, this is a very interesting one, and I'm again testing your eyesight. But for my own eyesight, I have actually written in with a big pen the numbers that I want to show you. This is a very interesting picture of the world trade, export and import. And what people usually don't realize is that between Europe and Asia, the bulk of the world trade takes place. Europe is responsible for 36% of export and of import in the world, and Asia for 32% of export and import. This compares with only 5% of CIS countries and only 13% of North America. So I'm giving you these numbers to show you that there is still an incredible world of opportunity where business can be done. And the Europe-Asia axis is very, very important as the bulk of the trade takes place between these two continents. I have a little bit of information which I have put on one slide called Meanwhile in Asia, and the point that I'm trying to make here is that since 2008 actually, even though Western European banks may have become more inward-looking, in Asia this has not been the case, and the foreign exchange reserves increased from $2 trillion in 2000 to more than 12 trillion in 2012, with expansion coming mostly from Asia. Okay, foreign exchange reserves are not the most important indicator of economic activity or financial wealth, but it is nevertheless a very strong element in our assessment of what's taking place in the world. Asia now constitutes 52% of the world's foreign exchange reserves, and China alone 25%. And the top 10 countries in the world include 7 Asian countries. Now, there are 3 AAA countries, Australia, Hong Kong, and Singapore, in the ranking of external ratings. I think it is interesting to see this, and this is a little bit of detail on the Forex reserves, Forex and Gold reserves, indicating the incredible amount of $3.3 trillion in China, very large numbers in Japan, the Euro system not doing too badly, even Taiwan, a very small country with 400 billion, Korea, of course, also very high, Hong Kong only has 10 million people, Singapore has 4 million people. So just for your reflection on this, yeah. And I have also some data on the internationalization of Asian companies, indicating that in the Forbes Global 2000, 10 years ago there were only 250 companies, now 733, of which Japan has 258, and China has 136 companies in the Forbes Global 2000. Yeah. I show you this to illustrate the potential of what can be done in countries if you have the right policies, the right mission, the right strategic insights, and a willingness to change. An important element which I want to mention in the context of this conference, and then I'm almost finished, is that one of the reasons for Asia's strong development relates to the development of regional banks. So not global banks, but banks which operate between Singapore, Indonesia, Thailand, Malaysia on the one hand, and then the link with Hong Kong, China, Taiwan, Greater China on the other hand, and then North Asia, the Japanese banks all over the region, the Korean banks all over the region, the Singapore banks extremely strong and developing business. So this follows the trade flows within Asia, but it also builds up the expertise in trade and expertise in project and infrastructure financing, which is so terribly lacking in this part of the world. So I wanted to mention that this is an important angle which actually very few people talk about.
You know, you talk about all this Asia stuff, and we're going to move now towards Europe and then into individual countries. To what extent do you think it's all been sold forward? In other words, you know, where we are in our economies all relies on this massive growth that's going on in Asia, and that any time we look at, you know, the dire prospects in Europe, everybody says, oh, it's okay because, you know, out in Asia there's all this growth. Now, anytime that growth seems to come off, it washes back with a very negative impact. Do you think that, I mean, is there a big risk to the downside that we're not going to achieve the sort of growth levels that everybody's hoping for out of Asia, which is the, you know, the machine of growth for the world economy?
Well, the last financial crisis in Asia was in 97, 98. In 2007, 2008, they felt almost nothing, of course a little bit. I think there were risks, there still are some risks in the system, but when I moved to China in 2000, actually everybody was also talking about the coming collapse of China and the collapse of the banking system, the insolvency of the banking system. Actually, it hasn't happened. It's still expanding. I personally think that the risk at this point is comparatively low.
You know, this issue with the cash balances. On the one hand, you've got the companies that say that they haven't got investment opportunities, therefore the cash builds up. I mean, I have to say, I'm sure in part it's because they want a cushion because they're not convinced they're going to get the money out of the banks. But on the other hand, you've got everybody wailing that the regulatory environment's the thing that's causing this deleveraging of banks. Well, you know, on the one hand, you've got increasing cash balances. On the other hand, the banks are deleveraging.
Yes.
That didn't seem to make sense to me.
It's an incredible dilemma, and I think that one of the consequences of the 2008 crisis is most probably, one I didn't mention, is the credit crunch in respect of middle-sized companies. I think the large companies have their ways and their financial management. They actually need the banks less and less, except for financial flows. There's been a lot of disintermediation. I think that what we will see is, what we should see is a development of the middle segment.